Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. Good afternoon, everyone. Happy New Year. Welcome to our 2025's very first Zoom session. Today, we're going to be talking about how to pay yourself from your own corporation, whether it be a salary or whether it be a dividend. So today's agenda, we're going to start off by first describing what a salary is, what are the advantages, disadvantages, followed by dividends, what are the advantages, what are the disadvantages, and then we're going to compare the two with actual numbers, followed by an example and conclusion. But before we start the discussion about salary or dividends, let's understand what are we discussing about today. So if you are a small business owner, you always want to withdraw money from your own corporation. How do you withdraw the money? Well, you have three options. One is to pay yourself a salary, the second is to pay yourself a dividend, and the third is actually repaying yourself the shareholder loan. All of these three options are completely, structured by the CRA. Every single option has its own tax rate, and from the corporation side as well as from the personal side. So today we're going to be taking a deep dive and understanding what are the intricacies of the taxes. So let's assume you own a business and it is called a convenience store. In that convenience store, you are doing roughly $50,000 in sales on a monthly basis. And now you want to withdraw some money as part of your salary. So you have a multiple options. You can either pay yourself a $10,000 salary or you can pay yourself a dividend at the end of the year. So both of the options are basically then going to be taxed at your personal level. But before we get into that, let's define what a salary is and how it's structured in Canada. So salary is typically something that you get paid monthly, bi-weekly. They're more cyclical and you have to contribute towards Canada Pension Plan, EI and income taxes. The good part is when you're paying yourself a salary from your own business, there is no EI component. You can do EI exempt. You basically, as the business owner, you are responsible for writing a check on a monthly basis of, let's assume, $10,000 a month, but you don't get $10,000 every month. You are actually paying $10,000 minus the deductions. So now you must be wondering, on a $10,000 salary, how much should actually be the deductions? Well, so if you look at our example, on a $10,000 salary, the actual payment that you received after deductions is $7,090.20. If you look at it from the breakdown of what this $2,900 was deducted for, it is easily can be seen here that the CPP component takes away roughly $577 on employee contribution side. Employer contribution is also $577, and the income tax takes away $2,332. So overall, if you look at it from the total perspective, you're responsible for paying $3,487, which is roughly $577 more than what was withheld from your salary, because employer also contributes $577.65 on your behalf when they're running your salary. And because of this, you will, at the end of the year, you will get a T4 from this employer on the basis of how much income you have earned. You basically need to be generating a T4 slip from your own business and giving it to yourself. The good part about having a salary is that it also helps create an RSP room. Also, when you go to the banks, they love it because when you're applying for a loan, they want you to basically get a cyclical payment every month, and it gives them comfort that you have a job that can pay off the loan and all of the outstanding credits that you might have on your file. The only disadvantage of having a salary is the tax compliance, because you have to pay yourself monthly and you have to also withhold the payroll deductions from your salary and pay to the CRA on a monthly basis. Now that we understand how the salaries work and what are some of the tax rates involved, let's look at the dividends. From the dividends perspective, you don't have to do the monthly compliance. So why? Because dividend is basically paid once a year, and at the end of the year, preferably based on how much profit you have left over, right? So if your business was convenience store, you were doing $50,000 a month in sale, and you had a bumper year, and you want to pay yourself some sort of a reward from the after-tax earnings, you can pay yourself a dividend. The good part about dividend is the tax compliance is less But the bad part is, because there's no deductions on the dividend on a monthly basis, you now have to pocket or foot the bill at the end of the year. So basically, when you're paying dividend, the CPP component, it doesn't exist. Again, great savings when it comes to paying yourself a dividend. But from the tax perspective of a corporation, dividend is not an expense item. Because it's not an expense item, it doesn't reduce your corporate taxes. It adds to your personal taxes, but it doesn't reduce your corporate taxes. It is sometimes favorable to pay a dividend because the CPP component is less, but the disadvantage is you don't have any reputation with the bank, because bank like to see cyclical payments in your bank account, and dividend is paid once a year. Now, because dividend does not have any EI CPP component, that also means you cannot move around your RSP room. So now your RSP room is zero because you only paid yourself a dividend and you can't really operate it that way. One final point I wanted to also mention is dividends does not impact your childcare room. It basically doesn't get added as a normal income to your file, which means your childcare doesn't get impacted. You might be eligible for a higher childcare. Now that we've understood the advantages and disadvantages of dividends and salaries, let's look at an example where we're going to compare three cases where one is only going to be salary, the other one only dividend, and see one with status quo nothing, and see how does it get taxed on the business level and how does it get taxed on a personal level. So if you look at case number one, you have $100,000 of income with meals and entertainment, insurance, salaries, office expenses, everything totaling up to $11,000 in expenses. So 100 minus 11 would work out to $89,000 of net income. Because corporation pays 12.2% taxes on first $500,000 of income, your tax liability would be roughly $10,800. That after paying that $10,800, your after-tax cash left in the business is roughly $78,000. Now let's look at case number two. We're gonna be paying $25,000 as salary. Same example, $100,000 of income for a convenience store, all the expenses related to meals, insurance, office expense, stationery, supplies. You have total expenses of roughly $37,000. Notice from the previous year, the expenses are higher because the salary of $25,000 as well as the CPP portion was added from the employer side, which is $1621. That brought down the net income from $89,000 previously to $62,000. And because net income is lower, the 12.2% is only $7,600. So after tax cash left is $54,000, which is lower, but the overall tax liability from the corporation side is also lower. Now that we have understood how case 2 is working, let's look at case number 3, where you're only paying yourself a dividend of $25,000. So in this scenario, you have an income of $100,000. You have similar expenses as previously, meals, insurance, no salaries, office expense, stationery, utilities, and your total expenses would work out to $11,000. Notice how dividend counted as an expense on the business taxes. That means your overall tax liability on your business will go up because dividend gets paid out from your after-tax cash that is left. So 89,000 times 12.2% would work out to 10,858. Your after-tax cash left is roughly 53,000 because you have paid a $25,000 dividend. So 89 minus 10 minus $25,000, that would work out to roughly 53,142. That would be your after-tax cash left. Now you must be wondering, we have overpaid taxes on dividend. What happens to the personal side? Well, on the personal side, you're only paying $300 in taxes, provided you had no other income. You only had $25,000 of ineligible dividend income. And if you look at the overall tax liability, your overall tax liability was still the same. So overall, you must be wondering which one is better. Is it better to pay yourself a dividend or is it better to pay yourself a salary? Well, from the overall perspective, the tax impact is the exact same. But if you wanted to maybe having a closing coming up, or you wanted to open up RRSP contribution group, salary might be better option. But if you have all the first time home buyer incentives used up, all of the RSP room maxed out, then maybe dividend might be a better option. So it really depends on where you are in your personal journey of life and where you stand for. Maybe you don't need to save for retirement, maybe you do. So that is something that you should be sitting down with your accountant to figure out what would be the right mix. I try to suggest that you should be doing $25,000 dividend, $25,000 salary, a mix to get the best of both worlds. But the final decision is based on your personal finances. So once again, if you haven't had a chance, book a call or meeting with us and we'll be more than happy to find you the right solution. Thanks and have a good day.